But our next guest is a little concerned, and he's lowered guidance ahead of earnings. Let's bring in Ike Boruchow. He's the senior retail analyst at Wells Fargo. Ike, it's great to see you. First of all, it's like 1 week we're talking about how retail's been doing badly this year. The next week we're talking about how they're doing great. How isn't the XRT like not doing that great? What is the story for investors in this space right now?
Yeah, Kelly, no, it's a good question. I mean, look, the market is forward looking. If you just talk to these companies today in real time, they'll tell you they feel great. Demand is outstripping supply. Everyone's got pricing power. Everyone's margins are reaching record highs. I think the issue with investors is we're all kind of looking forward, and we're seeing that, especially in my space, the softline space, we have overshot. And in our opinion, we've overshot on demand. There has been so much pent up demand, which has been fueled by reopening, stimulus, et cetera. We think of the apparel categories, the softline categories. Everyone has bought more than we normally do. So what's going to happen, what we talked about being more concerned, is inventory starts to build. All of a sudden, these companies get a little too optimistic. You overorder, you misplan. Right. All of a sudden, these record gross margins start coming down. That's the risk in the group, and that's why the stocks aren't really working.
So there we're showing the XRT, which is down about 15% this year. But you're highlighting three names that you're downgrading: Ralph Lauren, TJX, and VF Corp. Why do you think they in particular face a reality check here?
I mean, frankly, so we downgraded those stocks last week. We don't really want to play in apparel right now. I think apparel is a little risky. It's a category, like we said, that is overshot. The margin structures have all overshot. We've all kind of forgotten that for 8 years, this has been a very deflationary, very competitive space to play in. And so I think there's more risk there. Where we would like to narrow our focus and recommend stocks in the space that are also beat up, that also have great risk rewards, is really outside of apparel. So Bath and Body Works is our top idea. Tapestry, Capri, handbags. We feel this is a much better area to play if you're looking for exposure on the long side in our space.
So, Ike, I've been shopping pretty recently. I actually went to a Nike store, and a couple months ago, nothing was on sale. Absolutely nothing. I went in there this time, quite a few sales. So my question for you is, where are inventory levels at for these retailers? The cost to carry that inventory is only rising, whether it's warehouse space or just other factors. So where's the inventory levels yet, and how much is that weighing on the stocks?
No, it's a great point you're making, because there's two conversations. It's, how is inventory yesterday and how is inventory tomorrow? And I think that if you look back at 2021, it was the cleanest selling environment we've ever seen, and which is why all these companies have record gross margins and everyone believes that they've got the most pricing power in the world. I think the concern is, as we noted in our report last week where we downgraded the sector, is that inventory to sales spreads are starting to cross into negative territory. Our field work is showing that clearance levels, especially at the department stores, are starting to pick up. And I think that you're going to start to see that promotional intensity pick up, especially if what we're saying comes to fruition, which is these companies overplan on revenue and all of a sudden we have top line misses. That will really exacerbate the situation in the back half of this year.
Yeah, certainly a threat to some of these retailers, top and bottom line. I was actually speaking to the CEO of Duke Realty just a little bit ago. He said most of the companies that lease space from him, they're trying to pull inventory forward, worried about supply chain issues. So are supply chain issues also weighing on some of these retail companies? Because as you mentioned, last year was the cleanest that we've ever seen, but there's just so many factors weighing on the availability of certain products. And right now, I think a lot of us want to buy our spring clothes and our summer clothes.
No, that's a great point you just made, and that's what's dangerous, is you're absolutely right. Companies are now starting to order in excess of revenue growth. And when you talk to the management teams about what's going on, it's understandable. They need to get ahead of supply chain bottlenecks and constraints. So they're ordering more for less revenue growth in the back half. The issue with that is, like we said, if you start to miss demand even by a little bit, and now you're ordering more inventory to kind of protect yourself there, that's when bad things can happen, and that's when the decremental margins on those businesses come in way worse than we thought, and all of a sudden you thought a stock was cheap, all of a sudden the numbers come down 25, 30%. It's not cheap anymore.
Ike, we appreciate the insight. I got to tell you, though, I'm rooting for more sales. I like to go in the store and see sales.
Fair enough. Me too.
All right, appreciate the insight. Thanks for being here.